Welcome to the Capital Spreads weekly market view. My name is Zahid Mahmood, who's sitting for our regular commentator Angus Campbell, and I'm once again joined by our esteemed guest Bill Hubard, Chief Economist of markets.com. Thank you very much for joining us.
Thank you very much.
I'll start off with the most obvious question first of all, in terms of the figures we've had with the UK over the last couple of days. What do you think's happened?
Well, I think what has happened is, we got a much better than expected general employment picture, okay? And today we got a much better than expected retail sales number. Well, both of these numbers justify, verify what Sir Mervyn King had been telling us for the last, say, 6 months, that he wasn't discounting the Office of National Statistics, but he was basically saying that their numbers seemed to be far worse than what he felt was really happening with the economy. And I mean, if you look back, the unemployment numbers, the numbers that the Office of National Statistics, when you got that minus 0.7%, was basically saying we were losing like 250,000 jobs. Well, we aren't, and we weren't. Now, a lot of people say, well, will that be overtaken by the post-Olympic? But it basically says that when we get the second and then the third examination of the GDP numbers, yes, we'll still be negative, but I think we'll probably be minus 0.3 rather than the minus 0.7.
So do you think by that definition we could expect further rate cuts by the BOE or further asset purchase?
Well, I don't think we'll get another rate cut, okay? For the simple fact is, if you're a pensioner and anybody who's got money in a savings account, I mean, it's been a negative yield for, ad infinitum. Another 25 basis points would be meaningless. And even Sir Mervyn King, in the minutes that we got yesterday, basically saying that that really wasn't discussed. My feeling is that come the November meeting, which again will be the quarterly inflation meeting, I would expect 25 minimum, 50 billion maximum. I do expect another quantitative easing program.
Do you think that's the reason why the market seems to be moving higher in terms of the anticipation that central banks could be pumping more money?
Yes, and I think the people that, all right, to answer your question in 2 parts, yes, the market, for the reason that the equity markets are still, quote, hanging in there, as we saw with the VIX, what, at a 5-year low. Yeah. What volume is, where is it? But the simple fact is, yes, we're starting to see it, especially with the backup in the bond yields, feeling that the quantitative easing, whether it be from the Bank of England or the Federal Reserve, is starting to have a limited effect, but starting to have some effect in the real markets.
Okay, you mentioned the VIX volatility. Now, obviously, I think it's been noticed by many people that volume seems to be going up all over the place.
Yes.
What do you think would actually pick up the markets going forward from here? What do you think might be the issues that might pique a bit of interest?
I think we're going to probably have a 5-day window of opportunity. I think it will start on the 31st of August when the Kansas City Fed has their annual convention in Jackson Hole, Wyoming. Okay, the keynote speaker will be Fed Chairman Bernanke. And some of the invited guests will be Bank of Japan, European Central Bank, Bank of England, and some of the serious economists globally. Now, again, 2 years ago, in his opening speech, Mr. Bernanke did give the justification, verification, and almost the exact numbers for QE2. So the people feeling that all of the central bankers will be there. And we all know that they talk all the time anyway. So that will be the 31st of August. And then, of course, the following week, we do get the Bank of England, the European Central Bank meeting, and, of course, that following Friday, we get non-farm payrolls. And then, of course, following that, we've got the 13th of September. But the market now, the OIS spread is basically saying we're back to about a 35% probability that the Fed will do something. And the Fed, if they don't do anything there, which I expect them to do nothing, they can't do anything, of course, until after the November 6th presidential election. Because if they do, then it would look a little too politically along. So I'm expecting that week between the 31st of August and the 3rd or 4th of September to get the market started again.
So hopefully that should pick up the volumes of trade going forward. Just one thing, I've been a big fan of yours generally, so I know you normally give tips and stuff, so I'd like to know what you think would be your hot tip for the week going forward in terms of trading.
I guess what we've seen today, the difference between today and yesterday. Yesterday we were buying the dollar because we were concerned, okay? Today it's the risk on trade. We're seeing buying of the euro, we're seeing buying of sterling, we're seeing some buying of the commodities. One of the things, and I'm not a technician, but if you look at the S&P, if you look at gold, we're at very important technical levels here. Now, I guess maybe not so much this week, and I've probably been wrong now for at least, who knows, since I was born. My feeling is my 30-day outlook for the euro dollar is 120. And I think that is the level we're going to get sooner rather than later. As I say, today we saw some technical moves, especially option related. So my feeling would be is I'm looking to put on a trade, maybe not just in a week, but I would be looking to sell the euro dollar around 123.25 to 123.50.
Where do you think it'll ultimately go in that case?
My call is my 30-day outlook, looking at the economic numbers as they are, is 120.
Excellent. Well, again, thanks very much for your commentary on that. Please feel free to join us again next week. We'll have more commentary from our esteemed guest Bill Hubard again. Thanks very much for watching.